All right, let's get right into it. The market right now is in a really strange spot, almost like it's in a tug of war with itself. On one hand, we've got all these signs of a surprisingly strong economy, but on the other, you can feel this growing anxiety among investors. It's a real puzzle, and the pieces just aren't fitting together neatly. So that brings us to the big question we're tackling here. Why on earth is good news for the economy being treated as bad news for the markets? It's this strange paradox that just handed major indices like the S&P 500 and the NASDAQ their worst week in 2 months. Let's break down the numbers that are causing all this confusion. So this number right here, 3.8%, is really at the center of everything. That's the revised GDP growth rate for the US in the second quarter. And this wasn't just a small tweak, it was a huge upward revision. It was fueled by some incredibly strong consumer spending and a big leap in business investment. Honestly, in any other situation, we'd be celebrating a number like this. But this is where things get weird. Instead of a celebration, we got a sea of red. The S&P 500 and the NASDAQ both fell 0.5%, with the Dow not far behind. This is that good news is bad news phenomenon playing out in real time. The market isn't reacting to the economic strength itself, but to what that strength might mean down the road. And it wasn't just about GDP. The labor market decided to throw another wrench in the works. We just saw new jobless claims drop to their lowest level since June. So that recent little uptick we saw over the past few weeks, gone. It just adds more fuel to the story of a red-hot economy, which, makes the Federal Reserve's job of cooling down inflation that much harder. So here's what it all boils down to. The market's biggest fear is that all this strong data is going to force the Fed to keep interest rates higher for way longer than anyone wants. And as this bit of commentary points out, the longer they keep policy this tight, this restrictive, the greater the risk that they make a mistake and actually push the economy into a recession. That's the real worry. And just when we thought we had enough to worry about with the Fed, a completely different wild card just got thrown back on the table: tariffs. Seemingly out of nowhere, we have a whole new wave of aggressive trade policy that's just layering on a whole new level of uncertainty. And we're not talking about small changes here. This is a sudden, wide-ranging policy blitz, a massive 100% tariff on some imported drugs, 25% on heavy trucks, 50% on kitchen cabinets, even 30% on furniture. This is hitting a bunch of completely different sectors all at once, and it's creating a real sense of shock. This, of course, raises the scariest question of all. Could this create a stagflationary shock? That's the dreaded combination of a stagnant, slowing economy and rising inflation, because all these goods are about to get more expensive. That is the absolute worst-case scenario for the Fed, having to fight inflation while the economy is sputtering. So with all of these cross-currents and conflicting signals, what's the actual mood out there? How are investors feeling? And maybe more importantly, where are they putting their money? Let's try and take the market's temperature. Well, one of the best ways to do that is to look at CNN's Fear and Greed Index. And as we can see, the needle has swung pretty firmly over to the fear side of the dial. This isn't full-blown panic yet, but it's a clear signal that investors are getting much more cautious. The apprehension is growing.
And we can see this mood playing out across the board. It's a classic risk-off environment. People are looking for safety, and they're finding it in the US dollar. The dollar index has surged to a 3-week high, which is putting a lot of pressure on other currencies like the euro. Meanwhile, the yen is weakening against that strong dollar. At the same time, yields on the 10-year Treasury are also climbing. It's a textbook flight to safety.
Now, if we look at the CME's FedWatch tool, we can see exactly how this data is changing what traders expect the Fed to do. Based on where the money is going in the futures markets, bets on future rate cuts have been dramatically scaled back. In fact, the market has completely priced out 2 full rate cuts that it was expecting by the end of next year. That's a direct result of the strong economic data we've been talking about. Okay, so this brings us to the final and maybe most important part of this whole story. The market is absolutely desperate for some clarity, for a tiebreaker that can resolve this tension between growth fears and inflation fears. And we might get that signal very, very soon. Looking at the economic calendar from investing.com, all eyes are going to be on Friday, September 26th at 8:30 a.m. Eastern Time. Yes, personal spending is important, but the real main event is the core PCE price index. Why? Because this is the Federal Reserve's favorite, their preferred way of measuring inflation. This number is going to set the tone for weeks to come. And so, we end up right back where we started, at a crossroads. Is this PCE data going to come in cool, giving the market some relief and calming down those fears about the Fed, or is it going to come in hot, confirming the market's worst fears and just throwing more fuel on the fire of uncertainty? That is the question on everyone's mind. Thanks for watching. Don't forget to like and subscribe.